It's a no-brainer to switch from the S&P 500 into gold. That's what Ryan McIntyre, managing partner at Sprott Inc., said in a recent interview with Kitco News. We will explore his thoughts on the current gold market, S&P 500, and bond market in today's video. Hi, and welcome to Minuteman Precious Metals, where it's my goal to enhance your financial preparation and prosperity and motivate you by tracking my personal stacking adventure. Thanks to all my new and returning viewers. Please like and subscribe if you enjoy today's content, and ring that bell if you'd like to be alerted when new videos are available. I appreciate your views, but I really need your likes and subscriptions to grow this channel. Thank you for your support. Gold's new consolidation phase is creating an opportunity for investors to increase their exposure to the precious metal and the undervalued mining sector. In a recent interview with Kitco News, Ryan McIntyre, managing partner at Sprott Inc., said that looking at equity market valuations in the current economic cycle, it's a no-brainer that investors should move away from the S&P 500 and into gold and gold miners. He added that he expected investors to continue to buy dips in the market, which will continue to support prices in their elevated range. Investment demand in the gold market has been relatively lackluster for the past year as rising interest rates have raised the precious metals opportunity costs. However, McIntyre said that the focus on bond yields versus the cost of holding gold have been misguided. The switch for me isn't between treasuries and gold, it's between the S&P 500 and gold. If you look at the Shiller price to earnings ratio, it is trading at double the long-term average. To me, the opportunity cost of holding that is kind of crazy. Just think about how much earnings have to grow to burn out these high valuations in the S&P 500. Although gold continues to struggle as the Federal Reserve maintains its restrictive monetary policy, McIntyre said it is well positioned to take advantage of any new economic scenario. McIntyre explained that if inflation rises, the Federal Reserve will be forced to raise interest rates again. While this will increase gold's opportunity cost, he said it will also impact equity market valuations. A rate hike will be bad for gold, but it will be a lot worse for the S&P 500, he said. At the same time, it will take weaker economic growth to force the Federal Reserve to cut rates. Weaker economic activity should also weigh on equity markets. When I look at the S&P 500, my best case scenario is neutral, and my worst case scenario is really bad. But if you look at gold, its worst case is neutral, he said. At the same time, McIntyre said that because of growing government debt, U.S. Treasuries don't offer the same protection that they used to. Gold is probably the easiest solution as a safe haven asset, but it's the one that people resist the most, which tells me we are in the right place, he said. McIntyre said that although gold prices are consolidating, it wouldn't take much renewed investment interest to drive prices back to record highs. Along with holding physical gold, McIntyre said that investors should also look at holding mining equities because valuations are stupidly cheap. McIntyre's bullish outlook on mining comes after the world's top gold producers reported solid first quarter earnings. Gold's rally only really kicked off in March, so mining companies experienced only a third of the gold price move. Their margins will only improve, and traditionally the first quarter is usually where we see the weakest production, he said. McIntyre said that it's not surprising investors have continued to ignore the mining sector as companies haven't had a great history of fiscal management in a high-priced environment. However, he added that it appears companies have learned their lessons from the past. This is a really good place for the miners. There is some excitement, but not so much that they're starting to do stupid things. Investors can see a level of stability where earnings are good and cash flow is growing, but there is no excess exuberance in the marketplace. So what are your thoughts? Do you feel that the S&P 500 is overpriced? Do you feel that gold is the better investment at this time? Let me know your thoughts in the comments. Let's call it there. Thank you for watching, and remember, time is your most valuable asset, and I appreciate you sharing yours with me. Minuteman 6, signing off.